Overnight, China has announced some stimulus measures for their domestic stock markets. We're going to take a look at the details and also what the reaction has been after these announcements. And then today's Trading Takeout is going to be on why day trading should only be about 5 to 10% of your total trading type over the course of a year. But before we get into today's video, make sure you like this video and subscribe to the Axie official channel, because you'll want me popping up in your YouTube feed every single day to maintain your trading edge. So yes, yesterday we discussed the Chinese equity markets, and we were showing how, they're in a real mess at the moment. The Hang Seng was down considerably since the start of the year, and it wasn't looking too good. And it's quite timely, really, because at 2 a.m. this morning UK time, it said that China is said to reconsider equity market rescue package backed by $278 billion, according to Bloomberg. The Hang Seng immediately extended on gains and traded higher by 2.4%, which actually isn't that much considering, while it continued to advance to trade higher 3%, with the index at 15.4K versus 15.2K prior to the announcement. The Shanghai Composite recovered its earlier losses of around 0.3% and returned to flat territory within 5 minutes after the announcement. It kind of is a little bit underwhelming to me. If this were to be announced in the US, the market would be up 5%. It would be limit up, probably. I would argue that what we're going to see is nothing really changing. It's a short-term bit of shock, really. If we look at the Hang Seng now, for example, we'll see specifically, if I can actually get it up, there we go. We'll see specifically what I'm talking about. So this isn't really mind-blowing for me. We've already seen it almost exhaust. All it's done is traded to this high, and it's just formed a double top right at the 50 period moving average. So it's not really, screaming to me, oh yeah, let's get majorly long here or anything like that. If we have a look at the 200 daily moving average, we're still so below trend. It's actually quite insane. And we're only really probably seeing some form of reaction because we are in fact down at this low here. I really don't think that $285 billion is going to do much to change the fundamentals of the Chinese stock market. I think that there are broader structural issues here at play. But the one thing that it might do is it may solidify the extent to which US markets are in fact entirely the strongest in the world. It may lead to further capital flight to the US, because the one way that I might look at this now is I might be saying to myself, if China's stimulating, are they terrified about something happening? This is basically where I'm at right now. Is I'm thinking of maybe second or third order effects. I don't care about this now. What I'm thinking of here is, okay, well, what if Chinese growth really starts to surprise to the downside? Because why else would they be doing something like stimulating their stock market directly? Doesn't really make sense to me. Their growth's at like 5.6%, I believe. It's slightly higher than the US's. None of that makes any sense whatsoever. There is no reason to be doing this unless your growth was really in the bin. So this is really where I'm considering, okay, what if there are liquidity issues in China, and what are the potential spillover effects? Now, the main benefit of China having capital controls is that maybe these liquidity effects aren't necessarily felt. However, on a trade basis, China is, the warehouse and the factory of the world. So you might be able to see some economic discrepancies there, or some economic divergences where we're saying, okay, well, Chinese industrial production is getting shut down because of various domestic economic factors. How will this now impact Europe, the US, et cetera, et cetera? So that's really the way that I'm looking at things. But if we look more broadly, let's look at the Nikkei, for example. Nikkei 225. Nikkei, you know, I mentioned yesterday we had that big spike up. It closed a bit lower today, which actually it looked quite bearish. You know, this close is very, very bearish. A long wick here into a big spike up, and then we closed below the previous day's close. If you can get that into your head, so we closed below Friday's close. Looks rather bearish to me, and maybe there's some inclinations here that people want to level some trades off as well. Who knows? But beyond the point, it's still in an uptrend, but shorter term, it's bearish. Now, again, I might argue that closely related stock markets are going to benefit from the China stimulus more than Chinese markets themselves. That's the way that I would envisage this in the short term, at least. So the midterm view is the one that I just said, that okay, well, should we panic because China's stimulating? Short term, I think we're looking at it as, okay, China's stimulating, we should buy risk assets. That's the way that I'm looking at things, because I don't think that there's any immediate risks to equity market fragmentation or equity market volatility. But I do think it's a major story still. And I do think as well that, you know, when China is looking to ban short selling too, because they've expanded stock selling to curbs to insurers, so listed insurers, you know, it means that they're kind of flapping, they're panicking. I remember when this happened in Korea, and it didn't really work that well. The Kospi still fell relatively easily. So there's various things at play here, but I think in my view, we're looking at this as not really being that fantastic for the Chinese domestic equity market, and, you know, connected to that, the Hang Seng. And I think there'll be more benefit actually for foreign equity markets from this. So crux of it is that I would argue that the S&P 500 can still remain relatively bullish in the short term off of the back of this. But midterm, we're looking at maybe some fragmentation, maybe asking why China's had to do this. Maybe don't believe the Chinese growth rate as well. What's ironic about me being a trader is that I try and do as little trading as possible. But I see many retail traders wanting to do as much as possible, and in really, really short time frames. Today's Trading Takeout is basically make sure that day trading is only 5 to 10% of your total trading activity per year. Now, why is this? Well, the more you trade, the more costs you are giving up. And costs are one of the biggest factors as to why retail traders don't make money over a year. If you are trying to take as many opportunities as possible, you're also leaving yourself open to more losses, in effect. The way that I like to look at things is, if you were to smooth over a time period, you're basically giving yourself more opportunity for things like themes, trends, and less volatility in the short term factors to take over. So what we really, really want to be doing is having core beliefs about the market, putting our money online to trade those core beliefs. And then maybe, you know, that 5 to 10% of the time when you do spot short-term obvious opportunities, that's when we can ramp it up a little bit. You know, smaller position sizing, but being nice and nimble, scaling in quickly, scaling out quickly, getting in, grabbing the money and taking profit.